Welcome back to The Real with Rachel. I'm Rachel Smith, a local real estate agent with RE/MAX in Mount Airy, Maryland. And today, my special guest I'm so excited to have on is James Schneider with Eagle Creek Mortgage.
Good morning, Ed. Yay! What's going on? How's everyone doing?
He was on before with Dr. McMasters, and we did a little intake on what's going on with the market and the economic impact. But today, we are going to be talking about loan limits.
Ooh, exciting stuff. It's getting bigger. It's getting better.
I'm going to try and have like the cheering in the background.
Yeah.
But no, we're talking about mortgage loan limits because I think a lot of consumers don't realize that there are actual limits to a loan product when purchasing a home or even refinancing.
Exactly.
So there's limits on how much you can borrow. And once you hit a certain limit, then it turns into a different loan product, which would be considered a jumbo. Right. So James is going to break it down for us today. New announcement that recently came out for the year 2022 pertaining to those loan limits that have been raised. So we're going to get into that. So what's been happening? What's been going on?
Well, a lot, obviously. This is actually a really big move. It's more indicative of where the market was last year. Obviously, a lot of people that are still looking for homes, people are not struggling, but it started a lot of competition, right?
Yeah, I mean, that is a struggle. We're struggling, buyer agents.
Yeah, and it was driving the price up, and which is kind of rare. The FHFA sat there and realized, hey, we have to kind of make this move forward. And so what they did is the loan limits used to be $548.
Yes.
They bumped it up pretty much $80,000 to $625.
$625 is now the max. Now that's before going into a jumbo loan product. Yeah.
Going to high balance and then jumbo, which we'll go over here in a second.
Okay, perfect. So that's a big deal, especially I feel like in this territory. I was thinking about it. Hey, what is our average price? And we're, within Montgomery, Carroll, Frederick, Howard County vicinity that we like to operate. I like to operate within. $500,000 is a pretty common price point. So this is a huge impact in what it does to buyers' potential in their buying power, what their rates do, what it's going to do for sellers, because more buyers will now qualify for this specific loan product that maybe they couldn't meet before. So what does that do?
So it does a few different things. So right now there's a 548 limit. Let's just say 0 to 548,000, and then anything between 548,000 and let's say I think it was 832 is considered high balance. Yeah. So what's the difference, right? So high balance, you'll see this is considered a little bit more risky for lenders. So you'll see interest rates maybe be like an eighth, which is 0.125, or a quarter, which is a quarter, 0.25, higher than normal. Also, it can be a little bit more stringent in regards to guidelines.
Yes.
So now that they've made this 548 up to 625, you can buy a $650,000 house putting 5% down. Which compared to before, you didn't have that opportunity. And it makes it more, you'll get the better interest rate.
Interest rate.
But
you're able to be a little bit more competitive.
Yep, and it's also not as stringent.
Not as stringent with qualifications. Exactly. So when you go into a higher balance loan, because there's more risk associated with the lender financing that asset, which would be theirs asset as well, they're going to want to make sure that you're super qualified.
Right.
Not super qualified, but super. So it's a little bit more scrupulous. It's a
little bit more, and that's the reason you always see interest rates a little bit higher on a high balance, and that's because they're putting themselves out a little bit more than if it were just a regular conventional. So what that happens with, and this is the next point is, so now they're at 625. They have not made it to where it's going to be a jumbo loan, but if you kind of go apples to apples, like an $80,000 increase, you could be looking at like anywhere between 625 and 900,000 being a high balance loan, which is
a common price point around here.
Which is very, very common. But at that point, we don't know the number yet. I would assume it's going to be that $900,000 range.
Yeah, we were talking about that. But it's not published yet.
Right, it's not published yet.
Do you know when they announced that?
Probably
November?
Yeah, it'll be like November, December, I'm assuming at that point. But see, here's a cool thing. We'll go over this in a sec. But anything over 900,000 or whatever dollar amount they come up with will be a jumbo loan. So what does that mean in the long for 2022? You can buy, let's say it's 900,000, and if it's not a jumbo loan, you can buy a $950,000 house, put down $50,000. And then it's just high balance because it's not the value of the home, It's what the loan amount is.
The loan amount
That's what we have to kind of go off of.
Mm-hmm.
So if it's not a jumbo loan, it's just high balance. You don't need 2 appraisals. There's no major debt to income ratio, hard stops or anything like that. So
yeah, it changes the game, I think, in a big way. I think it really impacts this area outside of the DC Metro Baltimore area.
Exactly.
Come on, caffeine, kick in. Just because of where we're at, and the pricing points are higher in this vicinity of the country. So even though this is a national thing, I feel like a major impact is to be had here locally in the surrounding communities right outside of the nation's capital in Baltimore and this territory.
And that's the thing, is that with less stringent guidelines, you don't have to put down as much. Most jumbo loans, you know, you can put down 10%, whatever it may be. The rate's not as attractive, whatever it is.
Correct,
so now you'll be in a high balance or whichever way you decide to teeter. It makes things a lot easier. I don't want to say easier, but it's still guidelines, but it makes it more affordable,
accessible.
Accessible.
It makes it more accessible for clients
that are in that range.
Yeah. For a lot that there wasn't even that option prior to, because the qualification just wouldn't.
I mean, two years ago, if you try to buy a $900,000 house, you'd have to put down easily, because they've been raising this loan limit pretty dramatically, and it's not because this isn't a housing crash issue or anything like that.
Yeah, what's your take on that?
It's just a moderate. Homes on average go up 4 to 5% a year. This year, obviously, with the way it's been, lack of inventory, major demand.
Yeah, I've seen between 14 and 19%
it's been about 14 to 18, exactly.
Yes, and so obviously the loans
have to go up as well.
Have to match that.
Exactly.
Otherwise, we're going to see an imbalance with economic.
Exactly. So that's why they do it, because what was a seller's market, it's starting to plateau a little bit, a lot of it, but but it's you're seeing more homes in the market, but now there's not as much competition, and I think now we're going to start seeing that 4 to 6% appreciation that we normally see.
It is. And let's talk about what you're seeing in the market, what I'm seeing in the market, because it's interesting what we as real estate agents and as loan officers see. We're seeing it happen in real time before all that information is gathered and that data is published out to consumers to see for themselves. So, for example, when all of these crazy bidding wars of $100,000 and everything else was happening in February, which is spring market here, people, listen. February, March, April, May, all that is being collected. Come August, September, you've got these sellers that are wanting to take advantage of that same situation that this data is forecasting, but it's not. Not all of a sudden, but over time and in months, it has started to plateau. We're starting to see contingencies come back. We're starting to see longer days on market. We're starting to see multiple offers dwindle. There may be 1, 2, or 3, but we're again starting to see those contingencies. We've seen some things with seller credits coming through, and it's almost, if this is ever a term, but it's almost looking like a normal real estate world. I feel almost like that's a legal term to say, normal and real estate, the same sentence, but it's almost looking like a pre-COVID real estate market to a degree. We're starting to see some of that. Still getting multiple offers in some of my listings.
It's healthy. It's you don't have buyers that are pre-approved, worn out, battling. Like you said, it's 2 to 3 compared to 15 to 20.
Compared to 15 or 20.
And you're starting to see it also on the seller side. Houses that are on the market for a while, they're either overpriced or there's something wrong with it, right? So there are a lot of people that are still trying to price their homes like they're
thinking that they're going to
get that.
And the buyers are knowing it. They taste it. They know it.
They're like, okay,
and they're like, we don't want to play with you that's already high, because we're not going to go over that. So obviously it all has to do with strategic pricing, but following your realtor's advice, because all the agents in the loan, we're out there in the real time seeing it in the streets, as I like to say, versus the data that's lagging behind. But I think the market has plateaued, slowed down, healthy, evened out, balanced, whatever adjective you want to use. It's not how it was back in spring.
Right, which wasn't healthy for anyone. And it's for even for the listing agent, even for the seller. I mean, nobody wants to go through 15, 20, 30 offers, and then it's so many different things.
It's a lot, because remember, it's not always just about pricing too. It all has to do with terms and financing and what type of lender is backing them. and everything else. So it's refreshing to see
it
kind of even out a bit. Now, what is that doing for the rate? So, the burning question is, what's the current rate as of, what's today? Friday, August 22nd, 12 o'clock. We're filming this on Friday. What is the current rate, James? Come on.
So it's, as much as I hate to say it, although it's probably a good thing, rates have steadily gone up over the past several weeks. We are sitting in the low threes compared to
still historic low.
Still extremely cheap money.
Maybe I should use the word historic.
Yeah,
it's still very low.
It's still extremely low. You're still looking at low threes. And what some people don't understand, that's way below what it's normally on average. Just because 2 sounds great, 3 is still phenomenal. And depending on what you're playing,
4 is in like a whole
holistic,
world.
right? Exactly. But it really, and that's where it kind of comes down to. There's so many different products out there. What's the plan? Some people are like, hey, we're going to be moving in 3-4 years. So then you can start looking at different products where it might have a lower interest rate and all that stuff.
I like your approach to
that. And but in the end, it really comes down to, if we were to say 30-year mortgage, 10 to 20% down, I would say in the low threes.
And obviously good credit and all that fun
credit
stuff.
And all that stuff, exactly.
Okay, so we're in the low threes right now, guys. Again, not horrible. Now, and you still have options just because people will bring up, well, can I buy it down? Can I buy it down?
You can, and that's a discussion that's always
depends on your
depends on your situation, what makes sense.
But it's an option.
It's always an option, of course.
But it might not be worth it. So that again is something you want to have a conversation with.
And that's where it comes, is it worth paying $5,000 to pay your rate down to 2.875 and save $80 a month? It's completely up to you.
Yeah, it's interesting to see how that kind of shakes out when I'm telling my clients to compare it, especially like in a multiple offer, for example. And it's like, all right, if you go $10,000 up, it's going to impact the seller $10,000 instantly the day of closing. Whereas with you, $10,000 over a 30-year amortization, which you probably won't even end up paying most likely in most circumstances. It's what per month, 5 to 7?
Yeah, $5 to $7. And to be honest, the average mortgage life frame is about 6.5 years. So that means most people either refinance or sell or something happens
before that 30-year
amortization. Yeah. So just because you're locked into 30 years, you'll be locked in for 30 years, but the chances of you
actually living there with the same loan product
and all that stuff is
slim to none. Yeah. So every $1,000 in a purchase price is calculated to be between $5 to $7 a month in a mortgage payment. So at 10 times 7, that would, let's do it on the conservative side of that. So 10,000 more additional in a purchase price is going to translate to about $70 a month in your mortgage payment. And again, that's, you still got to add the interest, homeowners insurance, all that fun stuff too. And kind of an estimate, but just so you know the impact between seller, one instant hit during a day, and then calculated over a 30-year span is $100.
And that's where it comes. Obviously, money adds up, right? But that's where it comes to having a good buyer's agent to sit there and say, hey, look, you go 10, you don't really need to go 20, because all of a sudden that whatever, $60-$70 turns into $140, and then you're done.
And then your ratios are whacked out.
Right, and it's just
it's a fine balance.
Right, and it comes down to budgeting and what you're really comfortable with, and that's why we try to sit there. And I have some stuff that I sent over to Rachel earlier. She can always share with everybody here. But
while you're talking though, I'm going to pull up. Guys, we've got new software and microphones. I'm going to pull up your contact because I was thinking this morning, like, do you know how easy it is for consumers to apply for a loan, right? Yep. I think people get overwhelmed, like, I got to get all my you got to get your documents together, right? Most everything's digital nowadays. However, you don't have to package it up, mail it out, or anything else. It's really easy to do a loan application, and I wanted to share this, and I'll do it right off of his page, guys. Okay, so here we go. I'll meet James with Eagle Creek Mortgage. Yes. So here's all of his information. Local lender based out of Gaithersburg, lives in good old Damascus. Been doing this for years and years. Boom, there it is. Apply with James. So it's real easy to just click this link. And I actually already explored this just to make sure. But this is what happens is you're going to have your own personal login if you don't, after you create an account. So it's secure and private and safe and everything else. So I just wanted to kind of share that with everybody as to the process of applying for a loan.
It's easy. And then depending on credit and down payment and all that fun stuff, we're right now we're working with about 20 to 25 different lenders as a brokerage.
Yes. So broker. So real quick, explain the difference between a direct lender and a broker, and why a broker, the benefit that comes with that, because I find benefits from working with a broker, mortgage broker versus a direct lender.
So let's kind of, a lot of people are afraid because it's not our money. We hold nothing in-house. We work with, like I said, roughly 25 different lenders. It's their money, it's their guidelines and so forth. But the benefit is usually our rates are extremely competitive.
Because you can shop for the best
We can shop for the best rate. On top of that, to be honest, I'm at 117 straight purchases without any issues closing. So it's never about cool, well, you can just go talk to an underwriter. This is a day and age that I speak to my underwriters pretty much every other day if I really, really need to, or my assistant Sarah does. So but we have the options. We have different programs that we can use, bank statement programs, whatever it may be, to make sure that we can accommodate and make sure that it's going to be the best fit for your future outcome.
Yeah, the bank statement program is a big one, I think. It's also for people that are like independent contractors and stuff.
Right, independent contractors, and there are different 1099 programs, their own business, whatever it may be. Yeah, exactly.
It's an easy way to. I mean, you still do your tax returns,
right? Of course,
but the weight isn't as heavy.
Right, exactly.
Okay, got off a little topic there because I was so excited. But so versus a direct lender, they usually have to keep you all with what products they have in house, whereas he can say, "Hey guys," and it's essentially almost selling that loan.
We've had situations, where we will always shop it out before we ever sit there and write a pre-approval.
Okay.
Where one company kind of looks at ABC as ABC, but then the other one kind of looks at it as like DEF, and it gives you an opportunity to say, okay, well, this situation's a little different, but it makes sense. And one lender might say no, the other one will say, hey, this actually makes sense, we're good.
Yeah.
And that's something that we try to do.
And then there's that, that gives you the opportunity to go back to the buyer and say, hey, this is this and this. Right. If we move this here and move that there. Right. So whereas, again, when you're stuck with a set amount of products, you can't really do any creative thinking and think around. Whereas,
and that's what we kind of.
So it's cool.
That's what we try to do.
Good. Thank you for answering that. Because I feel like we need to just touch on that for a moment.
We try to get not creative, but we try to do creative financing to make sure that it's going to make sense. And I always tell people
options,
but it's also to make sure budget-wise that it makes sense. Because I never want to call someone 6 to 8 months down the road and they're not happy. Right.
Yeah.
So we want to make sure
everyone's fear.
Yeah, exactly.
Deal with that. So good news is now the loan limits are up. We're doing a little recap. So meaning more buying power, not as scrupulous if you're going to be going above that threshold of the old conforming limit. All good things. And I think it's also a kind of a sign of the market and just adjusting, and how everybody's kind of adjusting to this new rise in home prices. And I don't think we're going to see it drop dramatically.
No,
and if we do, I think we've got a little bit of time. And we'll do a recap with Dr. McMasters. We were talking about this earlier. We're going to do a recap and have James and Dr. McMasters on. We'll do a year mark, which will be in May, just to see what's been happening at that point. We'll be through spring market. I think we were right though, didn't we?
We were pretty close. We said we pretty much said that it's going to plateau.
It will slow down for.
And not trying to say we're geniuses by any means. It was almost inevitable. We are geniuses. But it was.
My kids think so.
Yeah. All right. We'll stick with that. But either way, it was kind of inevitable, right? It's
what goes up must come down.
Right. But I think for 2022, we're going to remain in this healthy market.
Yeah.
Especially since 2022 is only 2 months away. Rates will continue to rise. I would expect maybe upper 3s, touching 4 by like springtime. So, and this depends on everybody's situation. If you don't have a family, you have nothing to be tied to. Now's almost the time.
I was going to say,
now's the time to sit there and jump into house buying.
Yeah.
To be honest, I don't know what your thoughts are, but it's if you're a young couple, no kids yet. Like, this is the perfect time to kind of jump
It really is. Before February, if you guys are going to do something this year or whatever, if you're doing it soon, do it before February. Come February, we're going to be right back up spring market again. Exactly. February, spring market, mark my words. All right, guys, that is it for today. Super exciting news. Any questions that you have, I will leave James's contact linked below. Thank you so much for joining us. Catch us on the next one, Real with Rachel, where I'm Rachel Smith, a RE/MAX agent in Mount Airy, and James Schneider with Eagle Creek Mortgage. Thank you so much for joining us, and we'll